You're talking about very high delinquency rates on mortgages that we all thought were much higher quality than, for instance, you saw before the crisis.
Hi guys, Christian here, coming to you today with another video on the housing and mortgage markets and what the experts are saying about huge potential problems. I always enjoy listening to people much smarter than me, and Dave Burt is one of the investors who was documented in the movie The Big Short in 2007. He created a model that identified what mortgages were going to go bad, zip code by zip code across the United States. And now he's shorting the mortgage market again. His reasons have to do with increased costs of owning a home, along with the risks of COVID, and that owners will not be able to afford their mortgage payments. Let's listen to this.
When we first met Dave Burt almost a year ago, he was working on a thesis and a bet. He calculated that about 1/3 of U.S. homes are overvalued because of the rising risks from climate change.
These hazard events are increasing. These costs are increasing. These are just facts. I'm just not wrong about that.
Floods, fires, and wind will cause more damage, making the cost of owning a home go up. Costs from higher insurance rates, higher taxes, and uninsured losses. As the costs go up, the value of the home goes down, and consequently, the mortgage on the home is at a higher risk of default, just like during the subprime storm when home values crashed and millions of mortgages went bad. Burt should know he was one of a few clever analysts who recognized this early. He helped investors bet against the subprime market and make a fortune. He was featured in Michael Lewis's best-selling book, The Big Short.
Burt had the most sensational information and models to analyze the information.
Sure.
Can you do the same thing when it comes to climate risk?
That's what I'm doing right now.
That was just before COVID hit. Now he's adding it to the mix because he believes climate and COVID together make the bet even bigger.
COVID has created a lot of problems fundamentally for the systems that support the housing market.
About 3 million mortgages are now in government or private sector COVID bailout programs, and there is no guarantee that those borrowers will ever get current on their loans again. So the homes are at risk of foreclosure.
You're talking about very high delinquency rates on mortgages that we all thought were much higher quality than, for instance, you saw before the crisis.
So what do you think? Leave a comment down below if you agree or disagree with Dave, and also make sure to smash that like button. If you haven't seen The Big Short, you must watch it. Here's a short clip.
Michael, how are you?
I found something really interesting.
The whole housing market is propped up on these bad loans. They will fail. The housing market is rock solid. It's a time bomb.
So Mike Burry, who gets his hair cut at Supercuts and doesn't wear shoes, knows more than Alan Greenspan.
Dr. Mike Burry, yes he does.
You know what? I'm pissed off. American people are getting screwed by the big banks.
And I am getting madder and madder.
It's unbelievable.
Then this guy walks into my office and says,
"There's some shady stuff going down.
The whole world economy might collapse."
I'm sure the world's banks have more incentives than greed.
you're wrong.
No one's paying attention.
The banks got greedy, and we can profit off of their stupidity.
You want to bet against the banks?
I think we're either high or having a stroke. Kind of brilliant.
If you've already seen Margot Robbie in a bubble bath explaining the mortgage meltdown, feel free to skip ahead to the next chapter on how 3 million people are not making their current mortgage payment.
Basically, Lewis Rainieri's mortgage bonds were amazingly profitable for the big banks. They made billions and billions on their 2% fee they got for selling each of these bonds. But then they started running out of mortgages to put in them. After all, there are only so many homes and so many people with good enough jobs to buy them, right? So the banks started filling these bonds with riskier and riskier mortgages. Thank you, Banjo. That way, they can keep that profit machine churning, right? By the way, these risky mortgages are called subprime. So whenever you hear subprime, think shit. Our friend Michael Burry found out that these mortgage bonds that were supposedly 65% AAA were actually just mostly full of shit. So now he's going to short the bonds, which means to bet against. Got it? Okay.
Check out those numbers. $564 billion in mortgages are currently delinquent and not being paid, and the numbers continue to rise.
The latest numbers on coronavirus-related mortgage bailouts are in, and they're moving in the wrong direction. Diana Olick joins us now with the news.
Yes, Steve, after several months of general improvement, the number of homeowners in those COVID-related mortgage bailout programs has risen now for the second straight week, and that's according to Black Knight. They increased by 27,000 in just the past week, bringing the total number to 2.78 million. That represents just over 5% of all active mortgages. Now, altogether, that's $564 billion in unpaid principal. Now, these bailout plans, the bulk of which are administered by government entities like Fannie Mae, Freddie Mac, FHA, and VA, they allow borrowers to delay their monthly payments for up to a year and then pay them back either when they refinance the loan or sell the home. The plans are administered in 3-month blocks. Now, this week's increase was the result of a jump in FHA and VA plans, along with a slight increase for loans in private label securities and bank portfolios. Increases like this have been more common in the middle of the month. The strongest improvements in the bailouts have been early in the month when the quarterly plans expire. Now, of the 3 million loans still in bailouts, 81% have had their terms extended at some point since March. So we have to watch these numbers really closely going into the end of the month, Steve.
Yeah, Diane, I've got a bunch of questions about this. First of all, where does the loss, I mean, it's not a loss, right? Because they're taking this, as I understand it correctly, they're taking what should be paid now and tacking it out on the end. But in terms of the loss of cash flow right now, is that to the government agencies or is there a private sector part of that loss to cash flow?
Well, the vast majority of it is to the government agencies, and they have to pay things like the principal and insurance on the loans that the servicers had to pay for the first 4 months, but then the government backed them up after that. And you're right that it does get tacked on at the end of the loans. There are some borrowers who are going to have to go into modification programs. That's mostly those who are in the bank portfolios or privately held loans, private label, because those differ a bit. But again, the vast majority are in government-backed mortgage forbearances. The question is, they had that up to a year, and, you know, we're coming up to a year pretty soon when you get to those first borrowers who went in March. So we have to see whether that's going to get extended.
Not going to be able to refinance.
On all my loans?
What do you mean all your loans?
I have 5 houses and a condo.
With housing across the United States at all-time highs, when will the bubble burst? Leave a comment down below on your thoughts and make sure to subscribe and hit that bell notification to be informed when we release new videos.
You have any idea what you just did? You just bet against the American economy.